You want to know, what are the best stocks to buy now? And should you be buying stocks at all in this market? Is this a stock market crash waiting to happen or a golden buying opportunity? Today, I'll provide you with 3 key areas to help you navigate this volatile market. Number 1, analyze recession risks and probabilities with expert insights. Break down this tariff-driven market uncertainty, as well as some key dates and things to watch, and offer strategies as well as stocks to buy, depending on if you're a bear or a bull, and how to navigate this volatile market. Let's go. Let's start with the possibility of a recession. Jeffrey Gundlach, the bond king from Double Line Capital, recently shared his perspective, and you might be surprised at what he said.
That we've got ourselves in. But I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
Wow. Higher than 50% for a recession.
I think it's 50 to 60 is where I am.
In that interview, Gundlach points to factors such as shrinking government spending and the large U.S. budget deficit as drags on GDP. So which stocks would you buy if you're in this camp? If you think there's going to be a bear market, what do you buy? Of course, having some cash is a good idea so you can take advantage of those great prices. Additionally, diversification can help a ton. Defensive stock sectors include consumer staples, utilities, and healthcare, and they typically outperform in bear markets. So generally higher dividend type stocks. Now, one way to play this is an ETF, and that ETF, SCHD, which is a high dividend yield ETF from Schwab. It recently had a reconstitution. You can see on your screen big changes here. In fact, 20 additions, so 20 new stocks, and 17 stocks removed from this ETF. When you do back testing, the new portfolio or the holdings within this ETF, it shows you that it's geared towards high inflation environments like we had in 2022. And this is a high quality ETF paying over a 3.5% dividend yield. Now, with all that said, not all experts agree that a recession is in the near future. The reality is a recession's always coming. The question is when. And you also have to consider your risk tolerance, your time horizon, your blueprint, and more. We talk about how timing the market is impossible. So you shouldn't assume that a recession is going to happen necessarily. You shouldn't completely change your plan just because of fear. In fact, let's listen to another perspective. This is from the head of BlackRock Investment Institute.
We don't think a recession is in the card. We think there's a lot of resilience. In fact, I don't think the recession is the biggest risk. I think the biggest risk is long-term decision, infrastructure decision, and so on. That if they're put on hold, we're going to see a lower structural growth rate in the U.S. eventually, and that's much bigger deal than a recession.
In that Bloomberg interview, Bolvin argues that uncertainty is at its peak, which of course leads to a wide range of views. He believes that holding back on long-term decisions because of that uncertainty poses a greater risk to structural growth than the recession itself. Other analysts, such as JP Morgan, agree that the chances of a recession are higher, but it's not their base case. Of course, a major source of this uncertainty, pretty much all of it, is the evolving tariff policy. And April 2nd is a huge date to watch. Listen to the CEO of Defiance ETFs as she highlights the market's struggle to identify exactly what the Trump administration is doing with tariffs.
Earlier, we were talking, Sylvia, that it's difficult enough to even disentangle what the president's talking about or what the administration's talking about when they actually tell us what they're doing with tariffs, much less how quickly things change between now and April 2nd. So the market seemed to bottom last week. Had a good week last week. The S&P entered correction territory for one day, and now it's come out of that. Is it all related to tariffs, the on-again, off-again nature of it, or is this just happening with tariffs as a backdrop?
Good morning, Joe. I think that a lot of this has to do with tariffs, but more than that, it has to do with uncertainty. So what we know about the markets is anytime you have any kind of policy, whether it's from DC or otherwise, uncertainty about taxes, uncertainty about tariffs, the market doesn't like it. And what happens is investor sentiment starts to cool. You kind of get this going to the sidelines, a lot of selling of stocks activity. And, that's what happened here, right? So we just don't know. I think the market clearly liked the idea that tariffs were going to be targeted versus widespread. But to your point, we don't really know what that means yet, right? So that'll play out in the next couple of days. And I expect volatility to continue there. What I will say, though, is that markets like this almost all of the time end up being buying opportunities on these days where you get S&P near correction territory, in correction territory, NASDAQ in correction territory. This is how, long-term dollar cost averaging tends to play out if you're kind of a buyer on those days.
I definitely agree with that last part. I've been doing this for 25 years, and when you see selling nonstop for day after day after day, generally they become long-term investing opportunities. Now, with that said, you look at 2022, you buy the dip, and the dip keeps on dipping. So, of course, we could have a situation like that where the market just keeps going lower. We go into recession and so on. As a long-term investor, I'm a big believer of dollar cost averaging, and she mentioned that as well. Now, listen to this next clip, which makes the waters even muddier.
Well, Scott, we got a couple more twists and turns just in the past couple of moments. President Trump just hosting an event with some Hyundai executives announcing a major investment in Louisiana, brought some reporters into the room for that event. I had the chance to ask him a couple of questions about these tariffs that he's been talking about today. I asked the president about this idea of tariffs on Venezuelan countries or countries that do business with Venezuela. He's tweeted earlier today that he wants to put 25% tariffs on any country that does business with Venezuela. I asked the president if those 25% tariffs are on top of existing tariffs on those countries. He said, yes, they are. I said, does that mean you're contemplating 45% tariffs on China next week? He said, yes, those tariffs would be on top for any country that's doing business with Venezuela. As we know, China buys a lot of oil from Venezuela. So if this goes into effect next week, it could be a significant disruption for people who are importing from China. I also asked the president about this idea of reciprocal tariffs next week on April 2nd, and would there also be sectoral tariffs going into place? He said, yes, there will. There will be automotive tariffs and others coming into place. He didn't specifically say on April 2nd, but there will be additional tariffs coming into play as well on the sectors in addition to the reciprocal. So confirming that storyline.
The constant back and forth with tariffs creates significant volatility. Every single headline moves the market one direction or the other. While tariffs are a visible factor, some analysts believe that there's something much deeper. Listen to Mike Wilson from Morgan Stanley. He actually said recently we'd bottom at 5,500 in the S&P 500, and it did exactly that.
I think we came into the year a bit more worried about the first half. We had a range of sort of 5,500 to 6,100, and we hit the low end of that range. So, the fact that we bottomed right on that number, I guess, made us feel better that technical level was real support. But really, at the end of the day, everybody's talking about tariffs right now. But the reason the markets are lower over the course of the last 3 or 4 months has nothing to do with tariffs. It's mostly to do with the fact that earnings revisions have rolled over. The Fed stopped cutting rates. You had stricter enforcement on immigration. You have DOGE, which all those things are growth negative. And then tariffs is just kind of the final piece that kind of, got people really kind of bearish at the end. And I would say the thing that really got the S&P going down at the very end was when it became clear that the president does not care about the stock market, at least for now. And that lack of a Trump put was like really new news to people. So we felt like all of that sort of capitulation was good at 5,500. It started out with a low quality rally, which is what we expected, meaning a short squeeze. And then, what we noticed is that the revision factors on the Mag 7 are actually starting to stabilize a bit. So the last couple of days, those stocks have acted better, and that can take the index higher. Like how high? 5,900. So we're almost there. It's halfway done. The move has kind of already happened. I think the bigger moves are going to happen in these lower quality areas where the short base is still pretty stiff. And ultimately, though, I think I agree with a lot of the commentary you had on the panel there, which is that it's going to remain volatile through the end of the second quarter. So whatever rally we're getting now, we think probably ends up fading into earnings into May and June, and then we'll probably make a more durable low later in the year.
Wilson emphasizes earnings rolling over and revising down, as well as other growth negative factors that have really been the primary driver of market weakness. The tariffs simply act as a further catalyst and really an excuse for a lot of people to sell. Now, with all this volatility, some analysts are actually calling a bottom. Here's Ryan Dietrich from Carson Group, who sees positive signs.
Can this rally be believed?
Well, we think so. Thanks for having me on a green day. It's kind of rare here. One of the things, Morgan, that we like about this, What have we seen the last couple months? A lot of selling on Fridays and a lot of selling on Mondays. This is 2 Mondays in a row now. Buyers stepped in. Friday's up 4 weeks in a row. The market's kind of telling us some things, hate to say this time is different, right? The 4 most dangerous words. But we're seeing strength around those days that were weak. And historically, you tend to see strength around weekends in bull markets. So we like that. Now, the big question, last comment here. Can it keep going? We think it can. I mean, the first half of March is usually quite weak. The end of February is weak. I know a lot of seasonal stuff is out there, but just the over-the-top negative sentiment. I know lots of guests have pointed these things out, but I'll tell you, the anecdotal sentiment, just people I have never heard from in years were reaching out to me a week or two ago saying, should I sell? Should I sell? When you have all the sellers exhaust themselves, like I think we just did on March 13th, which is usually when you bottom in March, we think this rally has some legs to it.
So there's a bullish stance. Let's look at another bearish stance. I want to be fair and I want to paint the picture for both sides. While you're watching here, drop me a comment below and let me know, are you bullish or bearish? Has the market bottomed? Are we going into recession? Drop me a comment. Let me know your thoughts. Here's a clip from Kate Moore, who's the CIO of Citi, and she's suggesting that maybe it's not a great time to buy risk assets.
Yeah, it's uncomfortable to say this, but I would not be putting more money to work in kind of risk assets at this point, so equities or in credit. That doesn't mean sell what you already own. We want to be like medium and longer term investors, but we also want to be taking advantage of tactical opportunities. And I think the equity market is going to be caught in more of a trading range in the near term as both technical pressures and policy fears bounce us around.
In that interview, Moore suggests that the economy was already seeing signs of weakness before the tariff discussions. And of course, this aligns with people that we listen to today, like Wilson and Gunlock. So how are investors adapting? What are some other money managers doing with their money right now for their clients? Here's a clip from Stephanie Link. This is the chief investment strategist from Hightower, sharing her recent activity in stocks that she's buying right now.
4 weeks ago, I had 9% cash in my portfolio. Today, I have 3%. So I'm just trying to buy quality on sale. Yeah. It's not easy to do, by the way, because every day they keep going down.
Right. You've put a lot of money to work. And I think your thesis for a while has been that you're avoiding the highest of the high flyers, the Mag 7 stocks, the big tech stocks. You're looking at the real economy in other places.
Yeah, and that's exactly why I mentioned earnings. Like, what do I think earnings can come in at? And it's actually much broader and much better in other sectors.
More from Stephanie later in her exact buys, and I'm going to tell you if I'm buying the same stocks or not. Now, some of you watching are going to love this next part, others not so much. Now, Sylvia here says to avoid the mega cap tech stocks and the Magnificent Seven and buy some small cap, highly speculative names. In this clip, she's telling you to buy 2 very expensive names in the quantum computing sector. She feels that these are interesting, long-term speculative buys. And after you watch this clip, drop me a comment. Let me know if you think these are buys right now.
What I really like right now are the quantum names. I like IonQ and Rigetti. Those names in the last few days or so, last week or so, are actually up double digits. And the idea here is that, AI came out of nowhere. We all thought it was a bubble. Maybe some of the prices got up to bubble territory, but nevertheless, you're starting to see practical applications and monetization. So quantum, I think, is the next AI, and IonQ is the next Nvidia, if you will. And so it's pretty much like a quantum as a quantum SaaS type of company, QAAS. Biggest clients are Google, Amazon, things like this. And basically, you're talking about a market that's thought to grow about 38% between now and 2028 as quantum becomes, a reality and a practical application to different sectors. So I really like those 2 names. I think they're interesting long-term buy and holds.
So what do you think? Are you buying Rigetti and IonQ right now as long-term holds? Drop me a comment. Let me know. Okay, so back to Stephanie Link. She mentioned specific sectors where she sees earnings growth, including consumer discretionary, financials, and energy, really anything connected to the energy grid. She also highlighted Boeing as a top pick, citing improved execution and supply chains. Not to mention its most recent win, beating out Lockheed Martin.
Okay, consumer discretionary, Target, Amazon, financials, Wells Fargo, Bank of America, anything tied to the power grid theme, Quanta Services, Eaton, Nextera is a new position for me, and energy, SLB is a top 5 position for me.
You put 2/3 of your cash to work in the last 2 weeks. That makes you think that maybe a 10% pullback is all we're going to see here? Is that what you're kind of anticipating?
I think so. And then some of these other names that I just mentioned are down a lot more than just 10%. So I was just trying to find the ones that got super beaten down and where I think you could see positive revisions higher.
I'm in this camp. I believe there's a decent chance that the bottom's in. Now, I don't ever pretend to know exactly what the future holds. I cannot predict the future. But a lot like Stephanie, I had something like 13% cash and I have maybe 3% cash left. So I bought aggressively over $200,000, $250,000 over the last several weeks. Most of that was when the S&P 500 got to that 5,500 level. Now, I did buy some Amazon in the community portfolio. I've owned Amazon in the main for a long time. I also bought some Target in the dividend portfolio. I think when that gets closer to $100 a share, it makes a lot of sense. In the pandemic, March of 2020, Target was around $90 a share. So that's a strong dividend yield. It's offering well over 4% dividend. You can see 4.25% dividend. The 12 months trailing PE is 11.89. It's trading at $105 a share. So it's down 23% year to date, down 39% in the past year. This isn't a growth stock or anything, but if you're looking for a nice compounder, a DGI, they've increased their dividend over 50 years. Stay tuned because we're going to talk about AI stocks as well as some of the names I've been buying.
AI, we still are, very bullish on AI being a powerful source of drivers' returns. And as a result, we think it's possible to withstand higher rates, moderate increase in rates, and withstand those for equity. If we get a very significant adjustment in rates, which is not impossible given the uncertainty we're facing, depending on the policies that will be put in place, then it would challenge the view on equities, I guess, for the U.S.
So as you probably know, AI has been a huge focus at Fired Up Wealth for many years. We were pounding the table on Nvidia under $15 a share back in 2022. If I wasn't already overweight on Nvidia, long since $3.94, I'd be buying. It's 13% of my portfolio, but if I didn't own it, this recent dip here to $104.77 was a great buying opportunity. I still like the stock even at 120. I think it's going to be 165 to 175 later in 2025. Now I'm going to show you some of the buys that I've made. I've got 3 different portfolios. I've got a $2.5 million primary portfolio. I've got a community portfolio that's around $140,000. And I have a brand new dividend portfolio I just started this year in January. That's $105,000. So most recently here on the 13th of March, bought some GitLab. I think it's a good buy under $50 a share. Been buying the ETF SCHG. That's the growth version. Instead of D for dividends, G for growth. Also been buying Oracle under $150 a share, another strong AI player. Arista Networks, another AI player. I've also been buying Casey's General Stores in the main. AMD under $100. I've been trying to load up, actually dollar cost averaged up from the 70s. I also bought some Micron here at $86.77. Bought some Workday under $244. I've also been adding Qualcomm, as well as SMH ETF, that's a semiconductor ETF. And Marvel under $65 a share. That's a dollar cost average up. Constellation Energy under $200 a share. MongoDB around 175 here. I've been dollar cost averaging really anything under 200. I think it's a good buy. Community portfolio, Amazon, $189.97. Some more Uber, dollar cost average up under 70. Some more SMH ETF. Some SPRX ETF. The Trade Desk at 5507. Some more Amazon. Did a research report here on A-Lab, Astera Labs. Go check that out. I've been buying that in this portfolio as well. Taiwan Semiconductor, $170.97. SCHG in this portfolio as well. Trade Desk, $57.97. Some AMD in this portfolio at $95. Some more Micron, $87.77. MongoDB, $174.97. Some more MongoDB at $179.97. Some more Marvel Technology under $70. This is also a DCA up. Astera Labs, A-Lab, been dollar cost averaging most recently here, $61.97. Dividend portfolio, NVO, Target, Microsoft, Seagate, US Bank Corp, and many more. The market doesn't like uncertainty, and the market is confused right now. April 2nd is going to be a very important date, and really whatever Trump says is going to move the markets one direction or the other. Now, there's no question that the economy is slowing. The question is how much, and are we going to go into recession or not? I do not believe recession's in the cards this year. I'm trying to find long-term buying opportunities as a long-term investor to DCA prices I like, the stocks that are more beaten down than, say, the averages, the S&P 500, and thinking very long-term, 5 years out. So I might not be perfect with my timing. Stocks could go lower, but I'm very happy happy with the prices I've paid. I've got some more cash and I have the ability to raise more cash in an emergency. Hopefully this video helps you stay informed, to give you both bear and bull cases so you can make better decisions with your money. So if you're new here and you like videos like this, make sure you subscribe to the channel. And if this is helpful, drop me a like, drop me a comment. I appreciate your time and attention. Have a great rest of your day. Take care.